Hey everyone, welcome back to Corporate Decoder, the place where we break down the confusing world of business one filing at a time. Today we're looking at Anebulo Pharmaceuticals, and let's just say their latest move might be a bit of a shake-up, like a magician trying to make shares disappear. So what's going on here? Well, Anebulo Pharmaceuticals is telling us about some pretty big plans. They're looking to do something called a reverse stock split. Now that sounds complicated, but what it really means is they're going to reduce the number of shares they have outstanding. Think of it like cutting a pizza into fewer, bigger slices instead of lots of thin ones. The company itself, Anebulo Pharmaceuticals Inc., is based out in Texas. They're in the pharmaceutical business, which you know is usually a pretty high stakes game. Right now, their main thing is something called common stock, and each little piece of this stock has a tiny value, like less than a penny. This is what people actually buy and sell on the stock market. So, and where do they trade these shares, you ask? They're listed on the Nasdaq Stock Market LLC. That's a big deal, a place where a lot of tech and growth companies get their start. Now, here's a little detail. Anebulo is calling itself an emerging growth company. This means they're still relatively new and might have some special rules they can follow when reporting their financial stuff, which is pretty common for younger companies trying to get off the ground. Okay, so let's get to the heart of it. What's this big announcement about? The company's board of directors, the folks in charge, have approved a plan. Part of this plan is to do this reverse stock split we just talked about. They're waiting for their shareholders, the people who own the company's stock, to give them the green light too. They're hoping to get this done around August. Why are they doing this? Well, it's part of something called a going private transaction. This is a pretty significant move. It generally means the company wants to stop being publicly traded on the stock market. They want to take their shares off Nasdaq and stop having to file all these reports with the Securities and Exchange Commission or the SEC. Now, for the nitty-gritty of the split, they're looking at a ratio that could be anywhere from one new share for every 2,500 old shares, all the way up to one new share for every 7,500 old shares. That's a massive reduction in the number of shares out there. Imagine owning 100 shares and after the split you might only own one, or even less. And why do they need to shrink the number of shares so dramatically? The main reason is to get the number of people who officially own their stock, the record holders, to be below 300. When a company has fewer than 300 shareholders, it doesn't have to file those detailed public reports with the SEC anymore. That's a big administrative burden lifted, but it also means less information for the public to see. So what happens to the small shareholders, those who might end up with a tiny fraction of a share after this big split? They're going to get a cash payment. Right now, it looks like they'll get $3.50 for a share they owned before the split. If you owned a few shares, you'll get a few dollars. If you owned a few shares, you'll get a few dollars. If you owned, say, 10 shares before and they do a 1 for 7,500 split, you get a cash payout based on your original 100 shares. You'd no longer be a shareholder and you'd miss out on any future growth or dividends. This whole process, the stock split along with the cash paid out for those tiny fractional shares, is being called the transaction. It's all part of their strategy to go private. They've already filed some initial documents, like a preliminary proxy statement. Think of this as a heads up to shareholders, telling them about the vote they need to have and giving them some of the details about this transaction. They also filed a Schedule 13E3. This is a special filing for companies that are going private. It's designed to give shareholders all the important information they need to make an informed decision about the deal. And to make sure everyone hears about it, they put out a press release on July 23rd. This is how companies officially announce big news to the world. They're also being upfront that this report, this 8K filing, is just a quick summary. They really want people to read those other documents we just mentioned, especially the definitive proxy statement when it's ready. That's where all the super important details will be. They remind everyone that all these documents are available on the SEC's website, which is a great resource for anyone wanting to dig deeper into company filings. Anebulo and its key people, like the CEO and other top executives, are considered participants in getting the word out to shareholders about this vote. This is standard language in these types of filings. It just means they're actively involved in persuading shareholders to vote. And what exhibits are they including with this report? Well, they've included their press release from July 23rd as Exhibit 99.1. This is pretty standard practice attaching any important announcements. The report itself is dated July 23rd, 2025, and it's signed by the CEO, Richard Anthony Cunningham. He's the principal executive officer. Now, let's put this all together and think about what it means. Anebulo Pharmaceuticals is essentially saying goodbye to being a public company. They're doing this by drastically reducing their share count and aiming to have less than 300 shareholders. This is a classic going private strategy. What are the consequences of this? For the small shareholders, it's likely the end of their investment with Anebulo, at least in terms of future upside. They get a small cash payout and they're out. For the company, it means significantly less regulatory oversight and public scrutiny. They can make decisions more freely without constantly worrying about quarterly earnings reports or the stock price. However, this move also raises questions about the company's future prospects. If they believed they had significant growth potential that would benefit public shareholders, why go private? It could be that they see more value in operating without the pressures of the public market, perhaps to restructure to pursue a different strategy, or maybe even because they don't expect significant growth in the short to medium term. The fact that they are offering a fixed cash amount for shares, especially if the reverse split ratio is high, suggests they are trying to consolidate ownership and perhaps exit the public stage cleanly. This is a careful maneuver to comply with regulations that require public reporting. From a practical standpoint, going private can be beneficial for companies in certain situations, allowing for more flexibility and a long-term focus away from short-term market pressures. But it can also mean less transparency, which makes it harder for investors outside the company to assess its true health and direction. The key takeaway here is that Anebulo is making a fundamental shift in its structure and its relationship with the public market. It's a move that signals a new chapter, one where the company will operate with a much smaller, more concentrated group of owners and with significantly less public disclosure. Whether this is a strategic masterstroke or a sign of challenges ahead remains to be seen, but it's definitely a big change for the company and its remaining shareholders. Alright, that's our breakdown of Anebulo Pharmaceuticals' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.